And yet again, another one of our price objectives have been met with today's impressive upside. Statistics are giving off some data that may be of use for us in the coming sessions. Let's combine the best of our discretion with stats to gain an edge over the coming days. Welcome back to the channel on this happy Monday. This is ARCa, and let's dive into ticker symbol TTOO. What is up, you guys, and welcome back to the channel. Let's go ahead and dive in to ticker symbol TTOO, and you are observing here the daily chart, and in fact it's actually the bi-daily or the 3-day wedge that we've actually been kind of tracking here, right? So just I think it was about a week ago that we pointed out what the first target was going to be based on the price objective, right? So that would be this trend line here, actually taking the metric of the supposed area of breakout, right, from the top side of the triangle to the bottom. We apply it right here, which is the breakout point, and it was the breakout point, in fact, right? So you can see that price action led to a top side here of 33.20, and we were expecting a top side of about 32, right? So this the discretion here, the price objective number one, has been met right now. As far as the other price objectives, that was a 25.80 to a 27-cent resistance that we spoke of when we wrote this from 1838 to that target there. Okay, so now that that's out of the way, we could speak of these targets too, right? Of course, the center of the triangle, right? That would lead us to a target of about 41.27, which has or is confluent to the geometric 2-spot 618 golden mean at 40.36, and of course the top target here, right? This trend line here, taken from the top side of the triangle to the bottom side, that objective comes out to a target of, let's see, 62.19, which of course it is confluent to the 3-spot 618 geometric golden mean at 58.94, just about 59 cents, right? So this is, and of course I'm giving you here ranges, right? Because it's important for us to observe not a single target, right? It's just it's better for us to observe the probabilities with a range. 40.42 to 43.96 on the center of the triangle, and the of course the one that we just faced today. The importance is shown right now, right? So we were looking at a target of 31.99 or 32 cents, which was very much confluent to the 2 fib, but taking into consideration some historical supports and resistances, we came up with this range right here, 31.31 to 35.39, and you can see here that we surpassed the target that we were talking about to reach the 50% of this range in total, which ended up being that 33.20, right? So very impressive times here for TTOO. Let's go ahead and take a look at this team, because for the team here, go ahead and throw a like on this video, because I have actually performed one of the most extensive statistical backtest that I've done in any ticker ever. So, and the reason why I say this is because I have measured certain criteria using historical volatility represented by this indicator here, BBWP, Bollinger Bands with percentile, and which represents volatility or a dispersion of returns in a linear fashion, right? So let's go ahead and just put that back like this, and I have versed volatility with stochastic momentum, with your typical D and K percent being your 3-day exponential moving average paired with your 14-day exponential moving average, with a smoothing factor for those of you who are nerds of this stuff, right? With a smoothing factor of 3, standard stuff. Okay, now I have calculated any time that volatility has expanded to the critical expansion zone, right, which is within the 90 percentile, and started a contraction phase, and I have used stochastic momentum to give us that upside probability with its pivot towards an upside, right? So this pair is what I use here to measure the duration of an iteration, the upside thrust, and the amount of times that the profile, being volatility versus momentum, have guessed the upside correctly versus incorrectly. And this performed throughout the entire trading history of the asset on the daily time frame. And this is specific for an upside backtest. Okay, so now let's go ahead and move on here and explain what's happening. Now that you know that volatility is doing what it's doing, I can probably just make this a little bit bigger for us to see, right? So we can do it maybe like this and bring up the stats here. Okay, so yeah, the 1-day critical expansion to contraction backtest for an upside, you're looking at a total count, the total iteration count here being 38 iterations, and we have guessed 34, or the profile, right, volatility versus momentum, have guessed the upside 34 times out of those 38 correctly. That gives us an upside accuracy of 89.47% with an average upside thrust, aka mean, at 39.25% over the span of about 15.03 days. Now I have calculated. This is what I mean by me getting just super, like, this is the biggest data set that I've ever performed or calculated here. I have calculated the standard deviation, right? The standard deviation based off of this mean is 37.47%. But what I mean by this is that I have calculated the upper bound of the first, second, third, and this actually would be, sorry about that, I was just doing that whole copy paste game, right? First, third, and fourth, right? So in this case here, just so that we are all in the same page, we can go ahead and just make sure that this is listed as the fourth standard deviation, right? So yeah, I have calculated the upper bound and lower bound of the first, second, third, and fourth standard deviation. So using a normal distribution curve, a standard curve being this here. So the reason why I put this up here is because this is the one that I've been using with 3 standard deviations, right? But the first standard deviation is usually, it's within this area here. Second standard deviation would be here, and your third, and so on. So in this case, we are showing 1, 2, 3, and 4 standard deviations for distribution, right? So of course, you can observe that as the upper targets keep on increasing, the curve becomes smaller and smaller. That means that the probabilities of hitting those upper targets become lesser and lesser, right? So let's just go ahead and go over something first, right? Because the firing of the signal was actually right. Let's see. Yeah, that firing of the signal was actually right over here, right there. Right, so that's this is why I have that thing here, right? So now the upper bound of the first standard deviation. Let's go ahead and go over that first, right? So that's leading to 73.30% to the upside, which has that 89% probability. This is based on the the bell curve, right? So let's go ahead and kind of measure that there from the firing of that signal, right? So that would lead to, let's see, 73.30. There we go, 73.30%, right? And you can see that it reached the golden mean. That was 1.618 at 47.58, but we reached 49.54. Pretty impressive that it would take us to a golden mean. Right, so that was based off of the firing of the signal back here. This is where it fired off, right? And price action essentially came up to this point right over here. It just surpassed it and it pulled back, right? So that's how how the probabilities work. Now I started getting very curious here because the upper bound of the second standard deviation came up to 110.77%. So if we go ahead and increase this here to 110, that was right about here. Let me go ahead and just draw a line there. First of all, notice the target, 60.24. Notice the 2 fib at 59, at 59.50. It's not even a cent away. So now let's draw a trend line here, and I want you to see where the day ended. Look at that. Bam. Second standard deviation hit right on the money. right with that daily candle right here, right? So that was the end of that day, and we, of course, it just popped up a little more and it came back. Now, why did it pop up a little more though? So statistically speaking, remember, I'm not speaking of any fundamentals here. I'm speaking of just numbers, just stats, behavioral, and this is using historical volatility and momentum. Right. So now the push to the upside here that led to around 141% to the upside. Well, take a look at this. The upper bound of the third standard deviation, 148.24%. And what do you know? We had 141% right there on the upper bound of the third standard deviation. Now, what would happen if I were to calculate the upper bound of the fourth standard deviation from the firing of the signal? Now, if you don't, what I would, I guess to follow along a little more context here is whenever the moving average and the volatility component have started a contraction phase, right? Because this is from expansion here. You're contracting towards the downside and expanding towards the upside. Volatility is direction neutral. Okay, so what would happen if we were to calculate here the upper bound of the fourth standard deviation? That is 185.71%. So adding that from the firing of the signal takes us to a very curious target too. That takes us to 81.14, 81 cents. Now, please observe the 2.618 golden mean, 85.43. And yet again, we have another confluent target to another golden mean, right? So if we draw a line from that 81.14, let's go ahead and do that, right? Let's see how close we can get to it. That's cool. We'll draw a line right there. We'll make sure that it can be visible enough, right? Let's go ahead and make it really thick. There we go. And let's zoom out. And this is where, things get a little curious here, right? Take a look at this. We have a huge gap down here, right at about 88.71. And this thing is already suggesting between 81 and 85 cents. Because I read it right at 88, you have a huge gap. That would be a major resistance at around 88, what is the top side here? Of 89.01, right? So now what that does is that gives us a total range for us to observe, right? So now we can take into consideration that 81.63 that we have down here, right? And to the top side of that gap being 89.01. So let's go ahead and see how close. That should be good enough. And this now is a concentrated area of resistance. Now, I also calculated here the probabilities of hitting those targets. Now, if we were to take into consideration hitting the upper bound of the fourth standard deviation here, then you're looking at, these are the chances that you're looking at hitting that. So, right, mathematically speaking, you're looking at 0 spot. So this is 0 spot, not, 4 zeros, and 315%. This means that there is a 0 spot 00315 chance of a data point being greater than the upper bound of the fourth standard deviation. So you might be thinking to yourself, damn, there's like no chances of hitting that, right? And please remember, this is not taking into account any fundamental, right? Because I know that there's a lot of fundamentals here that are favoring the upside for something pretty massive. Right? So I don't know about that, right? So, but I do know about numbers, right? So here you go. But notice this. We hit 140% of the second standard deviation, right? I'm sorry, the third standard deviation. The upper bound of the third standard deviation came up to 148.24. We hit 141%. And what were the odds of hitting that in the first place? Well, I calculated that too, just for your reference. 0.15% that we would hit that 140% target. You hear that? 0.15 out of 100% chances that we can hit that 140% to the upside, but we did. All right, so I just want to put it there like that, just so that you can kind of gauge how this thing is moving, right? So, and that's why I calculated this very extensive data sheet here for us, right? So I did this by hand, just so that we can observe how systematic traders or how systematic solutions or mathematical concepts can be applied into price action using statistics, right? So now let's go ahead and move on here, because now we know what those upper bound targets are. We need to talk about a couple things though, because there is an imminent danger. First of all, daily time frame printed a very bearish candle. This is a daily shooting star, and a very prominent one at that, with a huge gap down here. Okay, so that means that there's a probability here that the sentiment may want to actually get this gap resolved. It doesn't always have to be. In fact, you can leave a gap for the rest of your life and never come back to it. For example, this one here, right? This is the 1206 to about 1179. And we still haven't actually covered that gap now, have we? That can stay as a gap for the rest of its life. It'll never actually have to get filled, right? So yeah, that's kind of how things work out, right? Here's another gap right here between a very small area, between the 6-cent zone. That will likely never get filled again either, unless the asset just really decides to drop to the floor here. Right? So yeah, I just wanted to point that out, because usually when we face a shooting star, especially on an upper time frame like a daily here, that would usually have a higher strike rate for a potential retracement. Now, it's not a permanent one. I can't say that it is going to be the doom candle here that'll take it to zero. And I don't know. But usually, when we're actually getting massive upsides like this, you would actually tend to take a breather here, come back, and then continue on to the upside. What I can tell you is that if you can observe the geometric means here, we already are approaching a very bullish area, and that would be the golden pocket. Okay, so the golden pocket is located within, or let's see, between the 0.618 Fibonacci ratio and the 0.382. Now, you know what? I know that I have some dedicated listeners here at about 17 minutes of this long movie here, right? So I'm going to go ahead and just tell you guys here so that we can shake off some of the paper hands, right? So I have opened up 30 seats, of which 16 have already been taken over the last week. And this is where a lot of people are confused. This is not a trading group. This is not something that I'm allowing you to enter as like a come in and then pay your monthly membership. No. What I am offering here as the ARC Masters course, this is a 16-week comprehensive mentorship program. So this is a high dedication type of course that I'm putting together. And I was not going to do it again. But I have a lot of people that have actually experienced some serious losses and have reached out to me via DM if I was going to offer this again. I was done with it the last time around, but I have decided to add it one more time so that I could be able to share some of this knowledge with you guys, right? So please go ahead and consider joining up. That's arcmasterscourse@gmail.com. I will go ahead and pass you the disclaimer, the syllabus, the whole detail, right? The entire detail of this. So go ahead and reach out to me whenever you are, or if you are interested. But yes, about 16 seats out of the 30 have already been reserved as of the last 5 days, or 7 days now, actually, with the weekend. Right, team? Okay, so now let's go ahead and move on to the next chart and see what else we have. In fact, I wanted to show you here. This is one of our indicators here, one of the algos that we just released, the ARQ series indicators, right? So you can always get in touch with us for that too, for the scripts, and we'll go ahead and speak to you about the sub packages. But within this is an indicator that has momentum within the price action, right? So if you can look at this like on a daily time frame, you will see very clearly how the candles color, right? So that is because it has MACD built into the script. Now, MACD is actually a momentum indicator, right? And it looks just like this. A lot of people, moving average, convergence, divergence. It looks like this. A lot of people use this one, right? There you go. That's what it looks like here. So this script, the script of MACD is built into the price action, so it can display in colors where we are within the MACD spectrum. So you can see here that we were green, right? We were green right up there too. You can see here that is back down to the red area. You can see that it's getting critically dark blue, and as soon as we start diving into deeper areas, it turns red here. right? So it is a momentum-based trend indicator that allows a display of trend lines. So this is in fact how I used this indicator to display to me this descending broadening wedge, because it actually displayed it by putting this trend line here. So I immediately noticed the formation right because of it, right? So not only that is that it gives you pivot points too. When it feels the weakness in the markets, it'll tell you this is the pivot point and likely a reversal can be hit here. The beauty of this indicator is that it can be used in any time frame. So let's go to the 15-minute. The 15-minute time frame is displaying something that we are already expecting. Please notice here that we actually had the pivot point right down here at about 1835. Right, or 1837, sorry, where I was speaking of I was speaking of a retracement back to 1838. Right? Some people got that entry at 1838. It dropped to 1837, perfectly executing that trade for an upside 60 to 70% move of, to the 26 cent or 20, to around the 26 or 27 cent target. Congratulations to those who did take that. So now what I want to point out here is that it has a pivot point right up here. It did notice it today. And that was right at around the 7:45 to 8 a.m. mark Pacific time, right? So it printed out the pivot point there and it started selling off. Now it's reverting, but I want you to notice that it still does not have, on the 15-minute time frame, it does not have the bullish pivot. Right, so that is indicating that this pivot is not done, and until you can get this print down here, we'll be able to continue on to the upside. Go ahead and get in touch with us at arqindicators@gmail.com for these scripts, as they are available as a pre-order now. So let's go ahead and now take a look at the 8-hour time frame Gaussian band. This is getting a little dangerous here, team. Yes, of course, we have the failure of the mid band, which means that we have a short-term upside tomorrow, highly likely to around 30 cents, and then this would essentially pull back to maybe around 26.86 to maybe validate. This is why I pointed this out, the 8-hour time frame, to maybe start validating the silver cross that we faced today, which is the no, sorry, this is actually a bearish crossover. Oh my goodness, wow. Yeah, let me make sure that I do have 21 and 55. Oh yeah, I do not. Let's go ahead and make this the 55. I almost died here thinking that this was actually going to make a bearish crossover. Okay, there we go. So yeah, we may actually come back down to validate either the SMA 50, or, paired with the EMA 55, or the EMA 21 at 24.21, right? So we have two separate targets here. Of course, the 24.21 has 22.65 paired with it, right? But we also have this very apparent bottom side target at 26.35. Still the same targets that I spoke of, about breaking out of the triangle, then coming back down to a support. Still those same targets for a reaccumulation phase. Okay, team, and now the last part of the analysis here is actually the fact that the 8-hour time frame, we have 3 drives of bearish divergence. So divergence is the opposition of price action versus momentum. In this case, momentum represented by the RSI. So what you're looking at here are 2 drives located in yellow, where you're creating a series of higher highs in the pivotal points here of the RSI, paired with price action making lower highs. So that divergence equals hidden bearish divergence. Sorry, team. I thought my son was right there. Okay, and now the other drive here, this is a longer term drive, which is actually validating a downside coming in too. That is a drive of regular bullish divergence, where it has a series of lower highs paired with a series of higher highs on price action. And it is, in a sense, phantom, since it is crossing price action in order for it to get from point A to point B. So yes, we have 3, and there are several other drives here too, but we have 3 confirmed drives of bearish divergence here, and it is suggesting a downside to come in, and we already know that though. Okay, so be prepared in case we do face that downside to that 24 to 26 cent level in the coming sessions. Okay, team, I expect there to be some type of recovery based on actually a few things. Actually, it would be right about here. The 3-day time frame is in the gravitational zone of the bear weakness percentile, suggesting a pull to the upside in the succession over that SMA 14. Same thing with the 5-day time frame here. Very, very much in a bullish area here. It is in the bullish control. I'm sorry. It is in the the gravitational zone, of the bear strength percentile with an upside pivot on both the SMA 14 and the RSI signal. Highly likely for it to get pulled to the upside. So we actually need the immediate short-term time. Hans, get down, buddy. Down. Sit. Sorry, guys, it's just my dog. He's creating all kinds of noise on the wood floor. All right, so anyway, we have an upside probability here on the 5-day time frame. And you can see here that every other time frame is also pivoted towards the upside, but we do have some shorter-term pressures to kind of solidify first. Right, so if we're looking at this in the immediate short-term time frame, yeah, you can see that push to the upside, just like I spoke of. We can face the gravitational zone here at 30 cents to get a pullback. All right, team, so that is what I'm looking at here for TTOO. I'm sorry that it's such a long video, but it was very important for me to share the entirety of it. Please take whatever I do show and iterate within these videos as just a form of entertainment, as I cannot suggest for you to buy, sell, or hold any assets whatsoever. I need you to do your own due diligence and everything will be cool. But with that said, I wish you well. A very, very good rest of your night, and I will catch you at the bell mañana. Adios.